Welcome to our class. We are going to review a 2021 November paper, and we're specifically going to look at what we call the final accounts. So we're told in question number 2 that a company called GBS 520 Limited for 12 months ending 31st December 2021 had the following statement. So these are the statements. We have what we call the trial balance with the fixed assets, accumulated depreciation on the motor vehicle, plant at cost, accumulated depreciation, trade debtors, provision for doubtful debt, prepayments. Then we also have the transactions for 2021, like sales on credit, 2,500, sales in cash, 150. We have distribution costs paid through the bank, 350. So these are additional information. Then we're also given adjustments to say that the company in this regard had depreciation 20% on cost, 20% that's on motor vehicle, and we're also given 10% per annum on cost. Then the buildings depreciated over 50 years. Closing stock was 150. We also have selling and distribution, selling expenses 30. The amount of 30 was paid for sundry expenses and posted in error selling expenses. Accruals of 198. 1st January 2021 related to salaries. And we had prepayments of 4,500 on 1st January related to electricity. Then during the year, we have 50,000, which was due to customers written off, and an additional provision for doubtful debts for 5,000, which was required as of 31st December 2021. So we need to understand the adjustments. I'm more interested in you applying the concepts and the adjustment firstly before we go into preparing the comprehensive statement and also preparing the balance sheet, 25 marks. All right, so predominantly in this book, we need to understand that the accruals concept reigns. The accruals concept is what dominates. So in these two books, we have what relates to our income statement, that is revenue expenditure, and what relates to our balance sheet, that is capital expenditure. So all these, we need to identify which one goes to the balance sheet and which one goes to our trading profit and loss account, collectively called the income statement. So let's do the identifications first of all. So the motor vehicle at cost, where does it fall? The balance sheet, right?
Balance sheet.
Accumulated depreciation, balance sheet. Plant at cost, balance sheet.
Balance sheet.
Accumulated depreciation on plant, balance
sheet.
Buildings at cost,
Balance sheet.
accumulated depreciation on buildings, balance sheet. Stock as at 1st January, what kind of stock is this?
Inventory, opening inventory.
And it falls under the
Income statement.
Income statement only. How about trade debtors?
That's a balance sheet.
Balance sheet. Provision for doubtful debts.
Income statement. Other expenses.
Both balance sheet and the income statement. How about bank?
Income statement.
Balance sheet.
Also balance sheet.
Balance sheet.
Repayments.
Balance sheet.
Both balance sheet and income statement. Share capital.
Balance sheet.
Accumulated reserves. Long-term loan.
Balance sheet.
Trade creditors
Balance sheet.
and accruals.
Balance sheet and income statement.
Income statement. So clearly the only thing that doesn't appear is just the stocks in here. Okay. So let's look at now our sales on credit and sales in cash. Collectively, we have what? The total sales, which is 20 what? 650. Distribution costs paid through banks. They go to the what? Income statement. Receipts from debtors directly into bank. They go to where? So this should, you can go ahead.
I think it should go to the balance sheet.
Okay, why is that so?
Because there we are looking at the debtors and the bank as well. The debtors who are is it paying directly into the bank? So I think that's what I can say. It goes to the balance sheet because you're looking at the debtors and the bank.
Okay, we're looking at the bank account, which is a current asset. So these alterations will be affecting the bank figure. All right. So we're looking at the balance sheet, yes. So this one is both income statement and the balance sheet because they are expenses, which are also affecting the bank figure. Then receipts from trade debtors directly into the bank. Okay, of 2000. So this is the current assets, so balance sheet. Then repayment of a long-term loan through the bank. What is happening here? We're having an effect on the bank account, but also we are reducing our loan since we are paying part of it, the long-term loan. So it's affecting the income statement. Payment to trade creditors through the bank. So we are reducing our creditors with the bank account. So here, this is a transaction using the income statement, the balance sheet. Then credit purchases 560, cash purchases 90. So this one is what? An income statement balance.
Statement.
Then insurance paid to the bank. So here we have what? Both the income statement, since insurance is an expense, and the bank is an asset, which is a current asset. Selling expenses in cash. What we have there? We have selling and distribution expenses and cash, which is an asset. So both bank and income statement. Then we have also salaries paid through the bank. Salaries are expenses, and the bank is actually a current asset. So we have repairs and maintenance paid through the bank. So repairs are expenses, and the bank is a current asset. So both are affected. Advertising expenses paid through the bank. So both are affected in this case. So it's an interesting question. Not an easy one. All right. Then we go to the adjustments. What does the first adjustment tell us? That the company charges depreciation as follows: 20% on cost. So since this is a motor vehicle, we just calculate 20% directly on the motor vehicle balance. So here, motor vehicle balance times 0.2 on cost. So we multiply this one times what? 0.2. So the 20% is what appears in the income statement. But what appears in the balance sheet is the 20% plus the accumulated depreciation. so that we calculate our net book value. So 590 times 0.2 is 118. So 118, we add it to the accumulated depreciation plus 224.5. We get what? 324.5. So this is what? Our total accumulated depreciation. So what actually happens is this. The trial balance has what is called accumulated depreciation in years. For instance, if you have 20,000, watch. Then you have a fixed asset, maybe which is 100,000. So there are two kinds of depreciation that you're going to have. Number one, on cost. If they tell you 10% on cost, for instance, just fine. 10% of 100 is what? 10 kwacha. So that is a depreciation which will go in the profit and loss account as an expense. But in the balance sheet, we're going to accumulate it because you keep accumulating. So this 20 that has been accumulated in years, there's a new one that we've added to it. So we're going to have the total balance sheet figure as 30 kwacha. But if they ask you to calculate on reducing balance, you first calculate the difference between the fixed asset and the accumulated depreciation. So 100 minus 20, which is 80, times 10%. So 80 times 10% is what? 8 kwacha. So 8 kwacha is what is going to go into the profit and loss account. Then the balance sheet, we're going to have 20 plus 8 kwacha. The total will be 28 kwacha. You get the difference, huh? Between on cost and on reducing balance. Are we together?
Yes.
All right. So that is depreciation on cost. We're just going through we're not going to do the books due to time. I just want us to understand. So here, 10% on cost. What are we told? We just find 10% on cost for the building, which is 10% of what? 1.5 million, which is 150,000. That is on cost. But in the balance sheet, we add the 150,000 to the 180 to get the total accumulated depreciation. All right. That is for, no, that is for machinery. 10% for machinery. Where's machinery? Machinery, say 10% would have been 45,000. So we add the 45,000 to this figure there, so that we get a total. But for the buildings, we're simply told that the building depreciated over 50 years. All right. So we calculate using the straight line method. Straight line method. The straight line method simply says you simply find depreciation, the cost minus what? The scrap value or the residual value over the time in years. All right. So now, if we're not given the residual value, we just assume the cost is what? Or the building is 1.5 million. So when you divide by 50, we're going to get 300 or by 50. Just a cost divided by number of years it depreciates. So it will be depreciating at a constant amount. So you just divide this by 50, and we're going to get 30,000. So 30,000 is what you add to this 308 to get the accumulated depreciation. So this is what it means, buildings depreciated over 50 years. So you use that. Closing stock, this is what we're going to use to appear both in the income statement and the balance sheet. Closing stock will be used to calculate
Sorry,
profit.
yeah, Mr. Collins, you said which 308 are we adding it to?
The 50. So 50 years. When you divide this by 50 years, so meaning each year it will be depreciating by what? By 30,000. So you add the 30,000 to the 380. This is accumulated depreciation on depreciation. If you want to take it to the what?
Okay.
To the balance.
Okay, I've seen it.
All right.
Thank you.
All right. Okay. Then closing stock appears both in the income statement and the balance sheet. And the balance sheet as our asset. All right. Any questions so far?
I think it's clear.
Okay. All right, so because of time, we'll end here. I will continue later on. Yeah. Thank you so much for your time.
Thank you, Colin.